How does monetary policy cause economic shifts? Imagine a central bank like the Federal Reserve or other national authorities adjusting the amount of money in the economy. These changes can ripple through the entire economic system, affecting how people and businesses spend and invest. When they tweak the supply of money and credit, it can lead to big shifts in economic activity. This is especially important when thinking about global economic changes, sustainable practices, and preparing for future trends. One main way monetary policy influences the economy is through interest rates. When a central bank raises interest rates, borrowing money becomes more expensive for everyone. This often causes people to hold back on big purchases like homes or cars, and businesses might delay expanding or investing in new equipment. As a result, overall spending slows down, which can lead to slower economic growth and lower inflation. On the flip side, lowering interest rates makes borrowing cheaper. This encourages more spending and investment, which can boost economic growth and push inflation higher. Another way this works is through the balance sheet channel. When interest rates go up, the value of assets like stocks and property can decrease. This makes it harder for households and companies to borrow against those assets, which can reduce their spending power. Less spending means less demand for goods and services, slowing down the economy even more. Banks also react to interest rate changes. When rates rise, banks may become less willing to lend because their profits shrink. This reduction in credit availability makes it harder for consumers and businesses to get loans, further slowing economic activity. Additionally, higher interest rates often attract foreign investors looking for better returns. This can cause the national currency to strengthen, making exports more expensive and imports cheaper. That can reduce exports and slow economic growth, especially for countries heavily reliant on international trade. Expectations about inflation also play a role. When the central bank signals it will keep inflation under control by raising rates, businesses and workers may hold back on raising prices or wages. This helps keep inflation in check and stabilizes the economy. All these channels work together to influence what is called aggregate demand, the total amount of goods and services people want to buy. When aggregate demand drops, economic output and employment tend to decline. When it rises, the economy can grow faster. In the short term, adjusting interest rates can help smooth out economic ups and downs, preventing severe recessions or overheating. But long-term effects are also important. If a central bank keeps interest rates high for too long, it can discourage investment and reduce the economy's potential to grow. Conversely, keeping rates too low for too long might lead to inflation that erodes savings and purchasing power. Understanding how monetary policy causes these shifts is key for long-term wellness and financial security. Stable inflation and moderate interest rates help protect the value of savings and investments. Predictable economic conditions support steady jobs and income growth. Being aware of these trends can help you make smarter decisions about borrowing, saving, and investing, especially in a world where global economic shifts and future trends are constantly changing. When economic policies are sustainable and well managed, they create a more reliable environment for achieving lasting wellness and financial security.